Before I turn it over to the panel, I just wanted to provide a quick update. I should say former CIO of the Hydro One Pension Plan. I retired as of June 1st. But the good news is my successor's here, Carolyn Sen. Now, Carolyn and I worked together for 14 years, so in the last 3 years, she was essentially the co-CIO. Thanks for coming, Carolyn. And the reason why I think that's good news is because if you have any questions for Hydro One, you know who to reach. It's not me, it's Carolyn. So let's start by introducing the panel. To my left is Mr. John D'Angelo. And I want to do this. I want to provide this bio because I think it's important. It's different than what you've heard today. And then you'll get a better understanding of the partners up here today, on the panel. So to my left is Mr. John D'Angelo, along with his position as CIO and Director of RGF Asset Management, Inc., is also the CEO of HBNG Holborn Group. Now, John brings 30 years of real estate acquisition, financing, development, and management expertise. He has invested in all real estate disciplines, including residential, retail, commercial, and office. HBNG is a leading Canadian provider of independent investment and real estate management expertise, which includes several entities that contribute to the real estate investment, asset management, and property management interests, creating a full-service development company. Now, to John's left is Mr. Christopher Brady. Chris is a director of RGF and president of land development and investments for the Remington Group. Chris is part of the third generation at the helm of the family development business, a privately held company with substantial land holdings, which develops and operates an extensive cross-section of residential, retail, commercial, and income properties. And to Chris's left is Mr. Mark Muzzo, also a director of RGF and president and CEO of the Muzzo Group of Companies and Pemberton, one of Canada's leading condominium and real estate developers. Now, their numerous developments can be seen throughout the Greater Toronto Area. Mark is also the chair of the Muzzo Family Charitable Foundation, which was established to assist, promote, and develop medical and scientific research in cooperation with hospitals, universities, and charities. So welcome, gentlemen, and let me start by saying thank you for participating and agree to share the story of what I believe is a very successful partnership between these development partners and Hydro One. And I say partnership, however, it really is a fund of one institutional pension plan, Hydro One, and 3 development partners represented here. So Hydro One, similar to our other investment managers and investment relationships, is essentially hands-off. The decision-making of the underlying fund we leave to most of the difficult investment development decisions we leave to the RGF team. Now, before I turn it over to the panel for a brief summary of the Hydro One pension plan and the investment with RGF Asset Management, so we'll lead into why we have this relationship, and John will explain a little bit about that history as well. So the pension fund is about $9 billion in assets. It's 130% funded, so we have about a $2 billion surplus. And by the way, Carolyn, that's the high watermark, just so you know. It's a strategic asset mix. Its strategic asset mix is what I refer to as the new 60-40, and that's 60% in public markets and 40% in private markets. Now, that strategic asset mix in public markets of 60% is pretty well plain vanilla. 50-50 global equity, fixed income. I won't go into the details because there's not really much to talk about there. Where we spend most of our time is the 40%. That 40% is invested in private credit, 5% in private credit, 10% in private equity, 25% in real assets, which is essentially real estate and infrastructure, pretty well split down the middle, 50-50. So that's about a $1.2 billion investment in real estate. Now the key point to real assets is that there is an inflation correlation. So it's basically a long-term hedge. And why this is important is because the pension funds, liabilities, the pension benefits are indexed to inflation. So we need investments that keep pace with inflation. And as a result, the benchmark for real estate is essentially CPI plus 4.5%. It's an absolute benchmark. So we're not trying to keep pace with public markets or fixed income. It's a CPI plus 4.5% benchmark. It's a pretty significant hurdle. And that portfolio is essentially globally diversified. And so it's invested across multiple sectors with approximately 70% of it invested in core, income-producing properties. Now, here's where we get into the RGF story. In order to meet this absolute benchmark objective and for diversification and growth, 30% of the total real estate is invested in opportunistic real estate, also diversified globally across Europe, the US, Asia, and Canada. Now, the Canadian real estate allocation is all value add, no core. Mainly, it's due to the fact that core has very low cap rates in Canada and is not going to give us the benchmark returns. We need value add. And also the fact that we have a very long history over 20 years. It actually precedes me, the relationship with RGF and John D'Angelo. So as mentioned before, the RGF fund is a unique relationship. Only Hydro One is an external institutional investor. John, heads up, I have a question around that later on. We also, if anything, I want to close by saying that this relationship with the last fund that we invested with RGF, it was a 2015 vintage. It had a 3x return, over 20% IRR, and has been the best performing investment in the total Hydro One pension fund. And so that's why I think this is an important case study to understand how we were able to do that. So thank you, John, Chris, Mark, the beneficiaries of the pension fund, thank you, and that means myself as well now, as a beneficiary. So let me turn it over to the panel so they can tell you about the fund and some of the world-class developments. And I'm just going to preface this by saying, feel free to talk about anything. John, bring some color. Mark, Chris, if you have any comments on anyone else's discussion, we're all partners here. We're all going to make this entertaining if we can. What I just talked about is the boring stuff.
Time for you to start talking, Johnny.
All right, Chris is going to sing. That's what.
Yeah, Chris does a great Elvis, so he might do this. I'm a little worried. I gotta be honest. Thanks, Rob. So that was a great intro, and I'm really happy with our performance. But the greatness about RGF is it's a little unique. Very simply, is because each one of us runs our own real estate development company, and what we tried to do is create a product. We said, okay, let's come together and let's see if we can create a product together. And we're going to try this with one institution, with Hydro. We know Hydro One. There's a good relationship. So if we screw it up, it's with a friend. But let's try this. So we thought, let's come together and see if we can, the three of us, put all the egos aside, because we each run our own businesses. Put all the egos aside, no self-serving agenda, and see if we can turn real estate development into an institutionalized asset product. So to do that, everybody, what we did is basically decided that the way it would work is we come together, all the opportunities, and we bring, a broad range of opportunities. RGF gets to see every opportunity. So that means it sees a tremendous amount of development land opportunities. And then RGF has the luxury of deciding if an investment works for RGF, what that investment would be, what's the allocation. So we're not basing it on, we have no motivation for management fees, fee driven, it's our money. At the table, right here is all the money. So it's our money at the table, and we wanted to see if we could create this product where, now we're 8-9 years in, and as Rob said, the performance has been very good. Could we continue doing this? Now, one of the reasons it works is the three of us get along, we respect each other, and there's checks and balances. We call each other out. So anytime, you have to be open to that, open to criticism. And I think we have this relationship. So I gotta tell you, you guys can comment. How's it been going so far?
Well, you're right, Johnny. What makes it unique is the three of us, along with Robert and now Caroline, come together. We have a shared vision. It's to generate the greatest returns. And we look at every asset class, from raw land development to industrial development to condominium development to low-rise housing. So we cross the spectrum on every type of development. I don't know, Rob, do you want to talk about certain developments individually, or?
Yeah,
Hold on. Before we do that, we do high-rise. So one of the reasons we focused on, we do all classes, as Chris said. RGF it's RGF, as Rob said, 2015, we focused on residential, both high-rise and low-rise. The reason being, we all know there's a shortage of housing, it's been very lucrative. So essentially, we look at our asset mix, and when we allocate and we decide how to do a transaction, an investment, we look at long-term land growth values, we look at a shorter term cycle where we can get in, add the value. We have a really good history of working with municipalities and getting approvals and entitlements. And then we go to the building, the marketing in the building. So that's a big deal for us, as well is execution. We control, and so trying to create an institutional investment product, it centers around the IRR. And real estate, we all know real estate development is not about IRRs. We battle this all the time, right? So real estate is long-term views. It's very difficult, annualized returns, IRR, but we've somehow accomplished that because how we look at land development. So we will take on a transaction that is shorter term. We do longer term land holdings with more equity appreciation. Really, it depends. The biggest thing is that we bring all of the opportunities to the table. As Rob said, it's discretionary. We'll battle it out. But in terms of the execution, we control our planning and design teams. We control our infrastructure. We control our building, low-rise, high-rise. And when I say we control, we don't just, it's our business. So we don't go to the market and price it. We do that to get the lowest price. But we own these businesses, so that's why we can hit the timelines. Because,
a lot trying to say is that we're vertically integrated, so
there you go.
We,
See, Mark, that's right.
We have every aspect of the business covered, that we don't need to go an outside source and get the information. It's all within our four walls, so to speak.
And one of the key points to that is when you're vertically integrated, and this came up earlier today as well, the vertical integration not only keeps costs down, it gets your money out quicker. You can get the jobs done quicker. When you don't have control of the development companies or the infrastructure companies, projects can take a lot longer, and we know that at the end of the day, IRR, the faster you get your money out, the higher the IRR. The longer it takes to get the same amount of money, it's going to lower your IRR. So that's the real advantage of it. It's not only to keep costs down, it's to maximize IRR.
Absolutely. I mean, we have a project now, and we'll jump into, a few years ago, we bought we refer to it as the Board of Trade, just as an example. The Board of Trade, I think under the Club Link scenario, it was called Country Club?
Country Club, yes.
Club. So when we purchased the golf course, it's a golf course. It's open space. We had a lease with Club Links, which actually, we had no intention of breaking the lease, because that lease finance part of it. So we used a lot of financial architecture, but you know, you're taking a golf course
There
that
it is,
is.
John, just behind you, there's a picture of the country club.
Right.
So it's just for the people in the audience can see.
Yeah, you see all that pretty green that's gone. No, so what we did is, it's very difficult. Anybody living on a golf course, you know, it's all that not in my backyard. So we had to embrace the community, embrace the municipality, because if you go in there hard-nosed and the municipality turns on, the people turn on you, the municipality will, you're dead in the water. So, you know, this is what we bring to the table. So right now, we're approved, we're beginning our infrastructure. So our internal infrastructure company, we went to market for the infrastructure tendering, and there was another company that was lower. So, I mean, we can always match the price, but the biggest thing is that, you know, when you give these and we had this conversation internally, you give it to another competitor, you're not their priority, and that's the problem. We need to be priority because we need to hit timelines. You were making a comment about that.
Yes, the timelines are important, and the know-how when it comes to the infrastructure and the planning objectives of the municipality. There's other golf courses and other places that have tried to get development approvals and have not succeeded because they've approached it the wrong way. What we do is a little bit different. We have an expertise in the areas of planning and development and infrastructure. And really what makes this such a unique fund, I think Robert, you were touching on it earlier, is the trust that the fund has in us as experts in our field, not in other fields, but in what we do. And that speed of trust really helps us get things over the finish line earlier and sooner, and in the most to maximize the profits of the whole project. So John often says we're land speculators, and I tell him we're not, we're land developers. But we argue back and forth because it's important to have that return happen in a certain timeline in order to meet the goals of Caroline and Robert's pension fund. Mark, you want to touch on that?
I think you said it all there, Chris. It's, no, in the sense that, you know, John's opinion's always been time is money, and as alluded to earlier, real estate is a tough game to do that, so.
And Mark and I don't ever sell, so, you know.
Well, that's the challenge as well, is that the family fortunes in real estate have been built on buy and hold forever. So a lot of times when we're divesting out of an asset, out of a property, and getting into something else, I mean, these two guys give me a big bow because they sell nothing. And you know, we're constantly trying to evolve our product. And you know, we can go on to another example.
I was just going to say that, John. That's a great example of maybe Mark. You can talk a little bit about 33 Yorkville, because we did take advantage of a situation where we were holding on to some property on Elm Street. Saw an opportunity. You know, COVID was. You know, we know what was going on with COVID. Basically, we never knew that. We thought that at some point maybe people would return back to downtown, but it was dead. And who knows if, you know, people are going to come back to work and when. So there was some really good opportunity. Mark, would you?
So to that point, Robert, you know, you're right. We typically don't sell if we're going to buy a high-rise site or whatever it is. Or the intention is to build it outright. So from entitle it, sell it, and build it. For instance, you mentioned our project that we had on 8 Elm Street, which was the whole intention when we first purchased that project was we were going to build it. So we got it entitled, we got everything, and the intention still was to build it. But I think when you do the analysis, the real estate market was so hot in Toronto, which sort of worked for you and against you in the sense that the construction price, this was a very small site, tight site, so construction would have been at a premium, particularly here. So that being said, when you looked at building this and the trades were at a peak, they were all busy, so the pricing on the hard construction was very high. But then there was a lack of product, so people were looking for sites. So when we ran the math to say, okay, listen, we're gonna build it out, it's gonna take another 4 years to get our money, 5 years to get it out. However, we can sell today at this number. It actually did make more sense to sell at that point in time. So it was probably a smart thing to do. We sold to another builder. They wanted the product, they were ready to go. And then unfortunately sort of COVID hit and changed the world a little bit. But I think one of the panelists earlier said it, quoted Buffett saying, you know, when things are tough, that's when you go out and you find opportunities. So we had found an opportunity at 33 Yorkville, which was across from the Four Seasons, whereby another developer had run into problems because of developer, and the site was actually under the trustee, it was in bankruptcy. And given the time period, I think it was early 2021 that we started looking at this site. There wasn't a lot of people at the table, but we all know the real estate business, the real estate runs in cycles like anything else. It's a question of how long the cycle goes. And do you have the wherewithal and the staying power to withstand the cycle? And this may sound as a bit of a cliche, but in real estate, it's location, 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 and you're in the heart of Yorkville here. So, you know what? We took advantage of this opportunity. We were dealing with the receiver. There was a few bidders. We were constantly running our numbers and pro formas and doing our underwriting very conservatively, I might add. But at that time, people were afraid to sort of outlay capital because of the situations was a bit of an unknown. We continued to go forward with it. The site was already approved, so and actually it was actually under construction. I think the hole was dug at least 2 levels. So, you know, there's a savings on the construction side there that we factored in and took advantage of. And I believe when we underwrote the deal and we closed on it, you know, there was a number of secured creditors listed on here, and we knew some of them. And there was one in particular that we said, okay, as long as we get their money out, I think we'll be okay on the number. And I think we hit the nail on the head because we presented a price that was just enough to get, I think they were third or fourth in line. But nonetheless, it was a number that we were happy with. It was actually on a per square foot basis less than what we sold the Elm Street site for, but in a better location. So it was everything pointed that we have to do this deal. So we did the deal, we closed, we ran to market, we adjusted the drawings to accommodate suite sizes today that work in this market because it's more so about affordability, so people wanted smaller units. And when we went to market, we hit it out of the park.
Mark's being humble because there's a lot of expertise that comes into getting the planning done and getting the approvals done. And so there was some uniqueness to the site that he's glossing over, but it's about knowledge and trust from Robert in his know-how and expertise to get the site over the finish line. That made all the difference in that making happen quickly. Again, that was the point, to John's point about, and Mark's, about time being money.
This is an iconic site. I don't know if Mark, can you talk a little bit about the tower itself? There's 2 towers, and this is going to be an iconic downtown Yorkville site, and I get excited being part of it because I know as an investor and partnering with our Jeff, we're essentially developers. We're built. I feel like I'm part of this build. So it's really exciting. When I'm downtown around Yorkville, I'm walking around, I have to stop by the site and take a look at what's going on. I feel like I'm part of it. So if you don't mind.
Yeah, so briefly, so this was the old Toronto Parking Authority site, and the part of the deal at the time was that the present developer, or actually the original buyer of the site, the condition for TPA selling was that they had to reinstitute the parking. So essentially our site consists of 6 levels of underground parking that have to go back to the Toronto Parking Authority, and then we sort of take possession from the ground up. So it's essentially, gross floor area of the site is probably about 1.1 million square feet with a shared podium, 2 towers. I think one is 69 stories, the other one's about 49 or 48 stories. About 25,000 feet of retail, another 40,000 of commercial. So it's and the commercial, can be considered office. And I heard in one of the panels before, everyone's a little bit weary of the office because of how COVID has changed the office experience. But I don't think we're too concerned about that, because what we're finding in the office side of it is, I think it was said earlier that if it's a Class A site, those are still selling. However, what we're finding as well, if you condominiumize the office and don't keep it as an income-producing property, people like to own their own office space, and they will pay a bit of a premium to do that. because a lot of these other towers down here, they don't have that ability.
This is what I'm talking about, Hydro One, you know, we, as investors, we can't do some of this and think this out. You really do have to partner with experienced developers or investors. You know, the only thing that I can take credit for is actually making the decision to invest alongside this group, RGF, so.
Well, I think it goes to what Chris said earlier, it's about the trust,
It
because
is.
how am I to convince you to say, hey, it's bad times to deploy money now, but I think you gotta relook at this and take a chance with us, and
That's
I'm
right.
glad you do.
We're talking about, I know Chris and Mark and John's 30 years, but you're two, three generations of building and developing. I think the trust there is that you know what you're doing, and when somebody knows what they're doing and they can consistently show that they can add value, and they consistently show that their expertise, that over time you have a lot of trust, and it's built over time.
I think that trust comes because alongside the RGF portfolio, typically we have our own skin in the game. So, if we have a dollar into it, we look at it as if we own it all. We treat it the same way.
Absolutely.
So
Critical point.
just to jump in here, it's great, but the biggest point is we rolled out of Yonge and Dundas into Yorkville at a cheaper price, made our money, like creating that institutional product in terms of IRR, annualized returns. That's all I preach. Like all the rest of the stuff is really pretty, but it's all about making money. So that's.
I do want to. I love that. And don't get me wrong. Hydro One, its objective is to make money, right? We need a return. That's key. And so we're looking for the best of the best. And so John, that motive is aligned. So thank you. I want to switch gears a little
Someone
bit.
needs to keep the eye on the ball on that. It's not just about buy and hold, and it's a long-term view. To create that product, you need to annualize returns. You need to look at time value of money. It's all about efficiency.
So I'm going to switch gears a little bit. Like I've got basically a couple minutes, so I'm going to do a really quick, high level. A lot of discussion today around affordability, and we need to build a lot more homes. How are we going to do that? And so really just very quickly, I know Mark and we talked a little about this in labor. Labor was a big deal, right? Trades.
Skilled labor.
Skilled labor. What can we do?
We have to grab from abroad. We have to bring skilled trades in from abroad because there presently is not enough. The retirement rate of these skilled trades is greater than those coming into it. So there's got to be promote sort of the skilled trades, the carpenters, the electricians, whatever.
So government should focus immigration on bringing in skilled labor in order to build more
to meet their
homes.
housing demands. They want to build 100,000 years. I think at a capacity, we've only been able to do about 50,000, Chris, in a year.
I think we can do about 100, but they're 100 behind.
Yeah.
I mean, we're about 1 million short now, and I think at the height in '74 we did about 220, but we can't get that. We can't get that. We haven't hit that in 50 years.
Yeah,
So 100,000 is about the number, and again, we're 100,000 behind in what we need to just achieve to satisfy today's market.
John, red tape, I know. Like we talked about
that's
this. So,
the biggest thing is here. I mean, fundamentally, the reason, we started with, we do all classes of real estate. However, residential real estate, both high-rise and low-rise, you're looking at tremendous demand, bureaucratic red tape to get the entitlements. I mean, there's a lot of value appreciation there. So we play in the pond that we feel gets us the biggest buck. That's really what we're doing.
last question, and I know we're hitting the time limit here.
Well, one of the issues that you have to remember on red tape and labor is also infrastructure. And you got to keep that in mind. It's nice to try to get to 100 or whatever the number is that you can build. The fact is, between sewers in the ground, water in the ground, hydro.
If you can't flush a toilet.
Exactly, we got a problem. And so that infrastructure is the biggest issue.
Yeah, there's a great
where
article.
government needs to get involved.
There was a great article in the paper about, I believe the mayor of Caledon, it was Caledon or Rome. And you just, the infrastructure is a key issue. You gotta build the infrastructure in order to bring in, 100,000 new homes. So switching gears, just one last question. John, I know I've been told we're running out of time, so I said I was going to ask you this because, and I know Carolyn and I, we talk a little bit about this, and that is like, we have a unique relationship, and like, I'm going to be honest with you, I don't want to be selfish here, but I'm kind of selfish, but it's okay. I think if there's other partners, I'm good with it as long as they're similar to like, our interests, and they're not, trying to get hands-on, etc. So John, what are your thoughts? Are you if the audience maybe is thinking about a relationship like this, is this an option?
So, as I said, I think what happened here is we wanted to create the product, the fund, the template to see if it works with the three of us. It seems to be working well, but the biggest, because it is our money at the table, we're fundamental, our money is at the table. To us, I think the belief is it's more about the partners than the investment dollars.
Yeah, I agree with that. It works because it's a symbiotic relationship between us and you fellas and folks, and we're all after the same thing, and it works because we get along so well.
Not all the time.
But that's part of it.
Well,
These guys are, old money and they never sell. It's a constant battle all the time, all the time. It's
well, I'm gonna change the word speculation to opportunistic. John, now I'm gonna put that in your vocabulary. We're opportunistic. Okay.
I
Thank
didn't
you.
use that at all.
Yeah, no. So
Usually that's all I do.
Thank you everyone for participating. Thank you, John, Chris, Mark,
Thanks,
for
Robert.
agreeing to do this.
Thank you.